Okay, very good. So today we are going to discuss about Jane Street fraud, or it is a kind of capital market fraud, and that is violation of one of the CFA Institute rules and regulations. Well, they are only not enforcing body, but of course SEBI and other capital market regulations. So what Jane Street is actually a company, they're hedge funds actually. So it is a kind of a hedge fund that manages in trading. Well, they do in many things, not only trading, but they invest in all kinds of stocks, bonds, currencies, crypto, everything, gold as well. So they include, and they're a very large company. Actually, since they're a private company, and it has been found by traders. So those traders who have been trading for years, means 30 years, rather decades. So they have experience of 25 years, 30 years. So they know very well how the market moved. And they manipulated in exchange value of options. So it was this ETF, or you can say this Nifty 50. So they manipulated the prices of Nifty 50 and Nifty Bank. So it is in India. They do in USA as well. That is what I suspect, because I cannot confirm or I cannot say unless I have this proper research, and I will have to prove as well. So I suspect it. So here is the charge. SEBI charged them that you are manipulating the prices of Nifty index and Nifty Bank index. So when did they do it? They do it especially on expiration day, when the expiration day of options. So let's see what are the expiration day of options in the Nifty market. So I come here. No, not this, sorry. This one. Okay, I come here on this screen. And can you see my screen?
Yes,
So,
yes.
yeah, you can see it. Okay. So here is the price of Nifty 50 equal weighted ETF. This is one ETF of Nifty. There are other ETF as well, but this one is Nifty ETF, and its price is in dollars. Since I am trading on US market and this is my personal account, so from here I can log in and see the prices. So in rupee term, if you convert it, it will be around 85 or 86 times 60, so around 5,000 rupees or so. So this is the price of Nifty ETF, and it is $59.25. It is being traded in the US market. Means I can trade on this platform, and since it is a US platform, so this Nifty 50 is being traded in the United States as well. Now this is the price. So if I want to buy one Nifty index, one ETF, I will have to pay $59. Okay, $59, around 5,000 rupees. And they are a very large company. They have 30 billions of capital estimated, because they are private. They are not public, so they don't publish, but it is estimated from their profits and some company information that they publish. They are not required to publish their actual capital or this 10K report. So they are not required to publish. So it is estimated that they have around 30 billion of capital. And 30 billion capital, 1 billion is 100 crores. And since $85 is 85 rupees is $1. So 8,500 times 30 billion crores. So how much do they have? Let's see it. Equal to 86. I do it times 100 times 30. So many crores, which is equal to what happened? Is it equal to 85 times? Okay, let me show in numbers. That's very. And then it is how to show it. Let me get. Okay, so many 8.6. So about it will be 8,60,000 crores. That is how much it should be. So they are such a big company. They can easily manipulate Nifty stock index. Suppose they buy for 1,000 crores or even 10,000 crores in the morning, it will go up. So now what did they do? So that is more important, and well, all things information. So this is the price. So if they want to purchase one ETF, then they can sell one covered call, and they invest how many? Maybe 16 lakhs. They invested in lakhs. So 16 lakh means they invested about 60 lakhs dollars. So 60 lakhs dollars would be around 5,000 crores. So they invested 5,000 crores around. It is just estimate. It is not that I am giving this figure. It is just for understanding. Someday they invested that much. Someday they invested much less. So when is the, let's go and trade the option. So here is the click. Trade ETF options. Okay, I am trading ETF options. So here it will show the prices of options. Strike price, you can see. So here is the price now, $59.25 is the current market price. And here is the expiration date. It is July 18. And its price is the call price. This one is here is the call option, and it is expiring on July 18. So its price becomes $1.90. Means about how many rupees? 180 rupees. This is the price when it is at the money. Okay. And you had studied about delta, gamma, all those things. So I will show that. So first of all, let's see the price. So here, when the market is at 59.20 and the price of $60 call on expiry on July 18 is $1.90. If the market goes $1 up, okay, means it becomes from here to here. From 59.25, so it becomes 60.25. What will be the price of that? The price will increase. And by how much? Since it is already up, so it is $2.35. Means what percent, or it is how much? 45 cents out of 190. So the market will increase by to $2.35, means 45 cents, which is around 25%. What does it tell? Let's see the delta. Now, here is the delta calculated. Its delta is only 0.0574, but gamma is 28. So the price change is delta plus gamma. Now gamma is 28 plus 5 means 33. So if they raise the market, the price will go by 33 cents. But this is not really very good example. I will show you the current one with another one, because its expiry is after 1 week. But let me explain you what happens when the expiry is theta. So here the expiry is July 18 and the price is $1.90. You make it August 18 because it is expiring monthly. So August 15 is the month next expiry. So if I convert it August 15, so you see that the same $60 strike price, but and same market price, means current market price, and this which is the underlying price, and the strike price is 60. So that increased from 190 to 250. So it is 60 cents increase. So in 1 month, the theta decay is 60 cents out of 190. Means what percentage it is? 60 divided by 19 means about 32%. So in 1 month, the theta decay means if they invest right now and leave them and the market doesn't move anywhere, they will still get theta, and the gain would be 32% in a month. So what inside do they get? That well, if they sell this call, for 190. Here I take it back to July 18, 190. And if the market doesn't move at all, they will anyway get 32% of profit in a month. So that is the kind of return on options. We get 1% monthly interest, and that's too high. And these government bonds give only a 0.5% interest in a month, but the option decay, theta decay, is 32% in a month. So that's how theta decay happens very fast when the expiry is smaller. And actually, the theta decay is more like what I would say, not parabola, concave kind of curve. So initially, the theta decay is very slow, but on expiry date, it becomes very fast. So this one is the one.
But if the price of Nifty had dropped because of other reasons, then the call would not be that desirable, and theta decay
They will get the delta also, yes. So if the price falls, they will get this entire 190. Then they will get this entire, because what will happen? On 15th August, this 250 will become, maybe how many days I am here? Today, July 18, no. So July 14, 1 week ahead, that will become 190. So so that will be the theta decay anyway. But yeah, if the price drops, then this will become 0, and they will get the entire 190 on July 18 for free. So they are now. And if the market goes up, so what did they do? They bought a lot of Nifty index in the morning. So SEBI had charged that they bought, and it gives an example of July 17, that they bought 24, how many lakhs? Let's see. They bought about 16 lakhs in one day on the expiration day. So I will tell you what happens on expiration day. Unlawful gains. Let's see. They bought, bypassing regular impact on retail worker liquidity. I think it was 16 lakhs or somewhere I had read it. I read it here only.
So initially they had given warnings 3-4 times, and only then they went for the ban.
Yeah, they gave yes. Here it is. On January 17, 2024, they made a profit of 734 crores in a single day. So they had given warning after that. Even in 2025, they had given warning that, well, we are finding these kinds of irregulations with you on Nifty 50 indices and Bank Nifty. So one thing is clear, that this stock market is not fair, nowhere in the world. Even in Indian market, it is already very inefficient, that we had studied. And the American market, though it is more efficient than Indian market, but it is not even weekly form of efficient. As per this Modigliani-Miller theory, it is not even weekly form of efficient, because this technical analysts also make money. And these guys are, what are they? These guys are manipulators. They do technical analysis, of course, but then they are manipulators. So what happens when we have this fast moving, like it was weekly? Now here, let me go on the expiration date. July 14 is on. I am taking another stock, another index, and this index is QQQ. Means this index contains Microsoft, Apple, all technology firms, big technology firms, and its expiry is July 14. So what is the strike price? Here the market is at $553. Now the price of the call option is $1.33. Okay. So if the market remains here only, this option will become out of money, and the entire money will go into the pockets of this company, Jane Street. The question is that, what did they do? They actually didn't do only one thing. They did two crimes. They profited both ways, on call as well as put. So let's see what is the delta. Here, since it is at the money, its delta should be around 50 cents. So here its delta, you see, 0.5 to 9. That is the delta. Expiry is only 1 day. There the expiry was 1 week. And the stock expired only in 1 month. But now it is near expiry. July 14 is only tomorrow. So when the expiry is there and it is at the money, so you see delta is 0.5 to 9. It should be 0.50 if it is exactly at that price. But here, the price is not exactly 554, but it is 553.55. So the delta is slightly higher. Had it been marketed at 554, its delta would have been exactly 50. Means if the market went up by $1, call price would go up by 50 cents. That is what it tells. And what was the gamma? Gamma is small here, only 9 cents. 0.09 means the gamma price will increase by 9%, and delta price will increase by 52.9%. And theta decay is minus 74. That is minus 74 within a day. Here, theta decay is very fast, because this when the price
if it is negative, what does that mean, sir?
Means it is declining. Like here, the price is $1.33, and 74 is only theta decay. Means in the morning it is 133, and in the evening, if the market remains here, the theta will decay by 74 cents. Means it will become only of 60 cents.
Okay.
So on the expiration date, theta decay is very fast. So theta decay will happen that way. And let me see if I can draw the graph. Then I will show you where to show this word. Okay, yeah. Let me open this file. Okay, I'm opening. I will delete it from here. So how does theta decay happen in a day or on an average? So theta decay is, I will draw, once it opens, I will draw. Though it is a book, it is not a blank one, but I will draw and delete there. So I get this opportunity. And it is a FRM book. So where to draw? Let me go down. And if I get a space, I will draw this. Theta decay will happen like, yeah. So here is, I got a graph. So I take this draw, and here is the day of expiry, and theta is in the morning, theta is like this. It will start from here. In the morning, theta will be like this. It will go like this, and it will be a concave curve. Though I am adding it is not. So here, the theta decay will be, so that is the kind of theta decay graph. So theta decay is like, so let me say this is theta decay graph. So in the end, the theta decay is very fast, and because it becomes out of the money. So within 1 day, if it invests just $1.33 in the morning, by evening, it will make a profit of how much? 74 by 133 means about 60%. So within 1 day, the theta decay will give a profit of 60% because it is decaying very fast. He needs to invest only this much money, and that will decay to 0. Means here is in the morning it is, he will invest at 12, and in the evening that will become to 0. That's the kind of theta decay happens. And delta, you had studied that it is 50 if it is at the money near expiration. That is what we had studied in Black-Scholes-Merton model or binomial model, that when it is, so two conditions are there. One is at the expiration and it is at the money. Second, then the delta is 50 cents, 0.5. So means if the stock market goes up by $1, option price, call option price will go by 50 cents. Means if it is of $2, then this becomes $2.50. Same with put down. So because delta is all the same for call and put almost, though the put prices are normally lower than the call prices. Okay, so we come here, and so here you see. Now what is happening? What did they do? Actual graph, I mean actual data. So if they're buying in the morning, because here it is the expiration date. So this call, which is 133, that becomes to 244. Means it increased by since it is on expiration date. So, and it becomes in the money. So since if the price goes up from 133 to 244, how much it is rising? About 89 cents. Means delta, gamma, when all added together, they become, or when this option is in the money, the delta becomes 1 when it is deep in the money. So at the money, delta is 50% or 0.50. And when it becomes deep in the money, it becomes 1. And when it is deep out of the money, it becomes 0. So that is the where the option prices change. So you see that if the market goes up by $1, the price increases by 89 cents. Okay. So what will they do? First, they increase the price. So let's say they increase the price by $2, means they purchased index, means how many? 1,000 crores. If they invest 1,000 crores in Nifty, they are buying. People will feel like you and me who are retail investors, oh my God, there is some good news. The price is going up, and probably we don't know. So they have started raising price, then we will also get motivated to buy that in the price is going up. Certainly there is some good news and we are not aware of that. So let's buy. And people will start buying. So these guys will spend how many? Maybe 1,000 crores, or maybe let's see 5,000 crores. And retailers like me and you will see the market rising, we will also start buying. And so the market investment may go up by another 20, how many? I have 5,000 crores. So another 10,000 crores. So maybe the market investment will go up by 15,000 crores. So these guys are knowing that if we do, others will follow. And so they will, once the market has gone up, so when the market goes up, suppose they raise the market by $2, so it will increase from, the call price will increase from 133 to 313. Means how much did it increase? More than 100%. 133 and 313 means $1, $2 and no $1.90. Yes. So the market price increased by $1.80. Sorry. 313 minus 133 is 180. Means
that is 183.
Yeah, 180. Yes. So how much percentage? 133 and 180, about 140%. So the call price increased by 140%. Now the price has gone up. So they sold the call because they know that we will drop the price. So they sold the call, which was only available if they would not have done anything, they would have got only 133. Now they increased the price because they purchased a lot of options. The price increased by more than 100%, 140%. If they increase only $2, means they can do that by investing only 5,000 crores in that Nifty. So its price more than doubled. It increased to 140%. Okay, it looks pretty good because they know that I will bring this market down today and all this will become zero. So the market went up and they sold the calls. So how many calls did they sell? Since they sold covered calls. So for covered calls, you have to have one stock, one underlying, then only you can sell one call. So if they purchased, say, how many 1 lakh units of Nifty, then they can sell only 1 lakh units of covered call. So they purchased, they were having from earlier as well. It is not that if they purchased today 1 lakh units of Nifty, 1 million units of Nifty, means SEBI says they had purchased 16 lakh puts. It was total volume. So call and put taken together. So put will be many more that we will explain right now after this. So they increased the price of the call and they sold it. After that, the market was not going to increase because they stopped buying. Now we come to the put. So this one is call. Here I press this put one, and this becomes the put price, the green. So what happens to put price? Put price is, since they had raised the price in the morning, so we will go down to the down. Means if the what will be the put price right now? So the put price is right now say $1.51. So we are covering for 554. No, so its price is $1.91, and the call price was 133. And what was the call? Okay, and why it was higher call price? Because it is not both are not put is in the money, and call was out of the money, because this 554 call was out of money, but this 554 call is in the money, since the market price is only 553.55. So it is in the money 45 cents. Now this is the put price. And if we take out of the money put, then that is also around 1.51. So here is this 553 put is out of the money, and it is 1.51 in the morning. Now what will happen? If the price goes up by $2, so what will be the price of this put? Let's go down. So it falls from 151 to just 93 cents. Means it is fall by how much? 51 and 7, 58 cents. So 58 cents out of 151 means it is another 35%. About 58 is about 35%. So 35% market put price fell. So what did they do? They purchased put at 35% lower, because they had increased the price of the index, so the price of the put fell down. Okay, let's see what is the delta of put. So I am putting this at the money put delta. So here the delta is 0.40, because it is out of the money. It is not exactly at the end. If I take the upper one, which is in the money, so let's see, that will be more than this. So here delta is 0.4. And what is the delta for 554? Its delta is 0.476. So since it is in the money, it went up. So if it is at the money, call delta is 0.5, put delta is also 0.5. But here the gamma is 768 and theta is again 84 cents. So theta is input also decaying very fast. So what has happened here? So they purchased put at 35% lower price. They would have been required to pay whatever price. By raising the market, they purchased it at lower price. Then what did they do in the evening? When the market price falls, put price goes up. So how much will this put price go up? We know the delta. Delta was 0.40 for this one, and for the when it becomes in the money, it becomes 0.47, and when it is deep in the money, means slightly more. Like, okay, let me go up and see delta will go up. If the market is here, then means if the put strike price is 555, its delta will be even higher. How much is its delta? Its delta is 0.55. So it increased from 0.47 to 0.55. So lowest, when it was out of the money, we saw delta 0.4. When it became little bit in the money, the delta increased to 0.47. When it became even more in the money, then delta increased to 0.55. And if it is again more in the money, 556, then delta will be 0.63. Means if the market price falls down by $1, the company would earn 63 cents on that. And let's add gamma as well. So gamma is 7, means 70 cents. So if they drop market by $1, they will make profit of 70 cents on how much? Let's see. 70 cents on how much? The price is $2.42. So the price of put is $2.42. If the market falls down by just $1, they will make 70 cents. That is 30%. So 30% is the net profit. investment is 242, 32 cents is the net profit. If they drop market by $2, then how much will be the price? It will go to 151. So from 242, so to 151, how much is it down? 90 cents, 91 cents exactly. So 91 cents out of 242 means it is about 35%, because, well, around 40%, because 24 times 4 is 96. So it is around 40% or 38% exactly. So that's how the price will the profit will increase just 38%. So they're investing 242 and getting a profit of 92 cents. Yeah, only when they drop the market by. So your investment is very low. In call, they had to buy the entire index. They had to invest 5,900 because its price was 60. So they had to invest 6,000, and then they had to buy the entire index. So they had to invest a lot more for selling covered call. But for buying put, they needed to invest only this much. And what if the price falls down by 3%? Well, after that, what will they do? Okay, yeah, because since put is in the money, so this entire money, how much will be the price of the put at expiration? If the price falls down by $3, it will go to 119. Means here the profit is about how much? More than 100%, because what they will do, that since the price was low, they purchased for 119 and that increased to 242. That is how it will be. So I think earlier I had explained a little bit opposite. Actually, since they purchased the put cheaply, the market went up. They purchased for maybe probably this much only, for 93 cents, because they managed the market $4 up and down, which is less than 1%, because its price is 554, and 1% movement is considered normal, very normal in the stock market. So they purchased put only for 93 cents and sold it for 242. How much is the percent? 300% profit around. 242 minus 93 will be 150. 150 or 149 by 93. So 149 by 93 means about 170%. Yeah. So they are investing 93 and reaping a profit of 242, means 170%. So the conclusion is that Jane Street made more profit on puts than on calls, on covered calls. So first, but in order to make profit on covered call, on puts, they had to sell covered calls first. They had to raise the market, and then they sold covered calls. So the entire covered call became zero. So whatever they sold for call, they earned. And how much have we calculated profit on covered call? I think it was around 25%, and added the profit of put. So put profit is 150%. So, well, it won't be 150% is profit on investment of put only. But they had invested much more because they had to buy the index. So I think they had invested 5,000 crore on index, and then on put, how many will they invest? Because they can invest any amount, whatever they want. So on 5,000 crore, they made a profit of 25% by selling covered call. No, not 25% on that. Actually, on call sell only they made profit. So it looks like that on option within one day they can easily make a profit of 40 to 50% if they are able to manipulate this purchase of index. Since they will have to invest at least 5,000 crores, then only market will move. And
Sir,
on that,
how is this whole process illegal, sir? Because all we have seen are strategies that we also study, and they have just made use of that on a large scale.
yes,
The market is not able to sustain. That means first the market is flawed and it is shallow. So if a person who has lots of money uses the right principles, he can gain money. So
Yeah,
how
yeah.
is that? How is it illegal? Why is it
How it
illegal?
is? No, it is not legal. These guys do it on their own because what happens that it is hard to prove. Now, how could SEBI prove that? How can you prove if you are a smart journalist or you are a smart investor? You are doing it for yourself. Then how can you prove? If you're an investor, you will make profit. Like sometimes I make profit from manipulation because I know that this is being manipulated. So, but how will you prove in the court that they manipulated? Because there was no news on that day, and it happened systematically on expiration date because it is July 18, and then this next expiration is August 18. Means it is expiring only one time in a month. It is not like QQQ, which is expiring every day. Like the look, this QQQ, its expiration date is right now July 14. Next expiration date is July 15. And then what will be the theta in one day? We had seen the price of put is 279. Okay, if I make 554 put, and if I put it July 14, then its price is only 191. So how much is the theta? 191 9 cents this side, and and 270. Oh my God, theta is 80. 80 cents. Sorry, not 80, 79 and 9. 88 cents. Let's see. Is theta 88 cents? Let me see what does theta tell. Theta is, yeah, you see, theta 65 cents on this day on July 15. And here, theta on July 14 is, let me see, what is it? Theta.
So even if they do it on the expiration dates, then that is just a strategy, no? Like instead
Yeah.
of
So
and
here you see,
also like you said, Jane Street is a private company, so they might have had access to private information, and not necessarily every retail investor must be having it.
oh, no, no,
So
no. SEBI knows that there was no information. There was no news on that day, and the market went up in the morning. In the first half an hour, the market went up very well. Now, do you want to see how the market is manipulated? I will show that graph as well. So here the price is, you see the theta decay is 84 cents. And we saw that we calculated 88, so that was rough. And it is exactly, you see the theta decay is 84 cents. So theta decay was 279 and 199, so that was the theta mainly. Okay. Now you were saying how to know market manipulation. Let me go and show you the financeyahoo.com.
because Jane Street, they are fined only 4,000 crores, but their overall profit is 30,000 crores, and they have deposited the initial margin around 16,000 crores. So
Yes,
like they can easily pay that 4,000 crores, and
definitely.
if they are such a big corporation, they must be having some kind of valid argument. They can't. I mean, they will also know if they are getting caught. They should have some backup.
It is clear cut this manipulation because if there is no news, then why did you buy and why did you sell it the same day? There was no news for that. So you have clearly manipulated. That is the problem. Means if there is
So,
news that yeah, Modi is going to do some.
if there is,
Yeah.
yes, sir, like for
So
example, if they had any insider access to government, and based on that, if they had done it, like,
yeah,
they
then
can
it will
prove
be
that
illegal.
also.
That is illegal too. That's illegal too. So if they do
But
on
sir,
the access
if
of
they're getting
government,
it from the company, that is illegal, sir. But if they're getting it from the government, how is it illegal, sir?
no, if they are getting from the government and government has still not published that report, then it is illegal. So a law is going to be passed, but the law has not been passed. And they got the information that this law will be passed tomorrow. Then if you do trading today, then that is illegal because you had the private information And yes, so that's how it happens. Let me go to finance because how is it too slow? Or it can show how the market is manipulated. Means if there is no news, then and the market is rising for no reason, then it is manipulation.
Sir, but if a market falls rapidly due to any one news, sir,
Then it is not illegal. Then it is fine. Then it is fine. Yes.
sir, isn't that would be subjective, no? Like in
No, it is not subjective because it's the news. The news is there is a reason for that.
sir, for example, if you had seen last week, there was one false news saying if you pay 25 lakhs, you'll be getting golden visa in Dubai. Every
Yeah,
news channel published that, but then afterwards it was confirmed that it is fake news.
yeah.
So,
Okay.
without knowing the authenticity of any news, if anyone does it,
Well, even if they do trading on that, then it is still news. So they can justify that, well, we thought it was true and we did the trading. Then it is not illegal. But when there is no news and people do trading, means they are buying, the company, only one company is buying excessively large amount and selling on the same day without any news, then it is manipulation.
that would be also competitors who are jealous. They would be seeing all Jane Street profits, and they will complain and say these guys are manipulating because they are not able to find the strategy. So they will say that.
Oh, no. They will not say that. They will have to prove no.
Yes, sir, that is how it started, right? Like one guy complained, and then only SEBI started investigating.
Yes, of course, the competitor SEBI is full of stupid people. So they are, I know, they are government bureaucrats who know nothing about capital market. So they work only when there is they work only when there is some complaint. And that guy, the complainant, gives them proof as well. That look, this is the reason and that's how they have done. Then SEBI will do. Otherwise, SEBI on its own, I don't think they can do it. They don't have the ability because they are the chairman is an IS officer who knows nothing about economics and finance. I can say because I got also one of them earlier, and I know my knowledge base. So, of course, someone complained them, gave them the full proof, and then only they did it. Okay, let me apply this. So that's how this market gets manipulated. And it is very easy to manipulate market for large hedge funds like this Jane Street. So it is really quite easy to manipulate. So this one is nifty. I see the market manipulation here. I'll give you the clear example. Q, and Invesco, let me see. Now here, the market has fallen suddenly, first of all, in the one day. So the market went up from here to here. And suddenly it fell. Then it rose. And then it fell. Then it rose. Then it fell. There is no reason for that. There was no news on last Friday. It was a calm day of yesterday because I am putting it one day. So,
sir, but that would happen with any stock on any given day, no? So like they will
no,
fluctuate.
no, it don't happen. Like there has to be reason, fundamental. We are doing fundamental analysis.
Sir, like one person might have seen a buy rating from any analyst, and the other must have seen a sell rating. So both of them take counter views, and if I'm placing buy for 10, and the other person places sell for 5, then the price will automatically rise because of
yes. Yes, so there is news because one analyst gave the news buy, market went up. The another analyst gave the news sell. Yes. Then after that, market fell down. These two are news. These two are different news. But neither any analyst gave any news, nor government gave any news, nor RBI gave any news, and the market went up because only one company purchased a lot of
Oh,
stocks.
okay, that happens with all micro cap stocks.
Yeah, that
that-
happens with micro cap firm too. Yes,
Uh.
they manipulate the market. But micro cap firm, yeah, many people this all. So never invest in micro cap. Like small company, they have 30 cent to 1 rupee, 2 rupee stock. Never invest in them. You are likely to lose that money. So because it will rise up to 5, 10, and then the profit is how much? 900%, because 1 rupee rose to 10 rupees. And then they will sell it immediately, and you will be left behind. Your rupee will become zero. So
that is a fundamental flaw with the free float equity available with each company method.
no, it is not fundamental flaw. It is the flaw of the government, which is not regulating, or it is the flaw of the regulator, who are not regulating. Otherwise, yes, it is not that flaw is there that can be controlled. The government is not regulated. You see, the market was suddenly from here to here. Okay, there was good news. No, actually there was none, and then it fell down. So this one is clear-cut example of manipulation. And because many buyers, many investors like retail investors like you and me, they say, oh my God, market is rising, let's buy. And they came here. And when the price went up, then those guys sold it. So what did they do? Here, they sold a lot of call and also bought a put it because they know that market will fall. And they did it. They dropped in market. So the price of put went up. They sold the put and took away the profit. Same here as well. Then after that, it is rising slowly, and then here it came, and then again sudden drop. So these kind of sudden drops, which happen without any news, they are clear-cut market manipulation by large hedge funds or institutional investors. So that's what Jane Street did. Means they made profit most on put trading, and then they also made profit on selling covered call. And the potential is that within 1 day, they can make a profit of 25 to 30% from their total investment. On their call and option investment, they can make profit to 300% in 1 day. Because we saw that on put, it had just doubled to 150% when the market went down only by $2. So theta decay, then delta and gamma. All these three work for put. They had purchased very cheaply put in the morning when the price was very high. Price of the underlying was very high. And then they also sold call very expensive because the price of underlying was very high, so the price of call was high. And the price of put was low, so they purchased put. And they made more money on put. The profit was more on put. So the question is, why didn't they do only for put? Because they could make money on put only because they manipulated the price of index artificially up. And that required investment of about 4,000 or 5,000 crores. So that is what all about banning of Jane Street Capital or Jane Street Group. That is
So
what reason.
if retail investors had not made losses, then SEBI would have not taken it seriously.
If retail investors, well, the psychology, yes, you are correct, but the psychology in retail investing is that, oh my God, market is rising. Let's invest right now because
Yes, so SEBI should first educate the investors, and also in case of options and futures, they should have a minimum bar like 1 crore or 2 crores to enter. That would be the best course of action.
You mean from the regulator point of view?
Yes.
Yes, the regulator will control this. But the problem is that the regulator, yes, the regulator can control it, but the problem is that 1% of up down is allowed. So 1%.
1%. Yes, sir.
Yeah, it is allowed. It is normal. So the government is actually working for the super rich people. They have made of course, they paid to politicians and made law. Otherwise, stock making money in the stock market by retail investors will also be possible. If the government controls or regulates the way you hold, then yes, you and me can also make money easily in the stock market because we know the fundamental and we will do this. Fundamentals work in the long run. These guys cannot keep the market artificially high for more than 1 day or 2 days because others will take the profit and leave. Yeah. So these guys cannot do that. They are doing it only in the short run. So 1 day or 2 days manipulation will work, but it will not work for a month. And that is where retail investors lose. So many retail investors lose who were fooled by a sudden market rise up in the morning on expiration day. So what did they do? They purchased call, and that call became zero. Those who were retail investors who were invested, okay, market has gone up. Okay, they kept the market up too for about 4 hours. And those retail investors who had purchased call, they felt happy. And who had purchased call? From these guys, because these guys have sold covered calls. So they felt happy in the morning and also during daytime. I am making good money. I have made a purchase of call. My call increased by 50%. Okay, they were happy. And the market closes at 3:30. So at 2:30, they started selling and the market drops quickly. And then they couldn't run away from the call. All their calls became zero. And those guys who had sold put in the morning, they also said that, yeah, because these guys purchased put and not a little bit, but 16 lakhs on January 17, 2024. So they were selling, I sold put expensive. I am making good money. I sold for this 50 rupees and now it is only 40 rupees. So I am making a profit of 25%. They were very happy until 2:30. After that, when the market fell, that 40 rupee put became 200. Now these guys all lost because they had sold for 50. Now they have to pay 200 to Jane Street. So that's how these retail investors were robbed. Now these retail investors didn't complain. It is only some big market makers who is here, like maybe Rakesh Jhunjhunwala is dead, but someone like that who are dealing in option market, they would have complained to SEBI, and then only that, oh, we lost today, this Jane Street pulled me and I lost 5 crores today. Jane Street made 740 crores that day, 746 crores. Means it is the Indian retailers and some big retailers who were market makers, they lost money. And it is the market makers who complain. That's how, that is what all about Jane Street banning story. Any questions?
No.
Okay. So we stop here then. And if you get something interesting and you want me to cover, I will explain that because I will give you the actual data. You saw I gave you the actual trading. I went on trading platform and showed you what delta, theta, gamma are and how the price moved, so that you can understand that what why. Otherwise, if almost no journalist will be able to explain like this, giving actual manipulation results.
Yes, sir. Sir, so since you have found out QQQ, can you complain and see if it is?
No, I made profit on that.
Okay.
I am a very small buy, so I cannot complain to SEBI. I made profit on that because I saw that it is being manipulated. I purchased put, and then so I made profit on that. I was doing trading yesterday, so I made profit on that. I know, so it is now clear that all stock markets are being manipulated by large investors. And so fundamentals work only in the long run. Technical analysis, one can make money out of that. It is clear. Whatever CFA Institute may tell that no, market is semi-efficient, market is not semi-efficient. it is being manipulated. So you have to be, but you have to be smarter than those manipulators.
Right.
You have to understand that yeah, they are manipulating, and then you run slightly ahead of them. Then you can make money.
Yeah, yes.
Okay. Okay. Good night.
Thank you.
Welcome. Let me start.